Welcome back to our live panel discussion, live from New York and Paris also. So welcome for this exciting last panel discussion before the closing session. I'd like to introduce you our panelists who are going to talk about the theme COVID-19 and acid test for infra-debt investors. So let me introduce the panelists. First, we'll start with Alban Delacelle, Chief Investment Officer and Managing Partner at Generali Global Infrastructure. Anthony Ferrero, Head of U.S. Private Placement and Program Bonds at Natixis. Charles-Henri Lecointe, Global Co-Head and Head of Infrastructure Debt North America, Legal and General Investment Management. And last but not least, Mansi Patel, Director, Vice President, MetLife Investment Management. Hello to you. And for that panel discussion, we will have two moderators, one in New York that I will present, Joy Chatterjee, Co-Head America's Credit Syndicate at Natixis, and also Antoine Saint-Olive, Head of Infrastructure and Energy Finance Syndication, EMEA at Natixis. Joy, the floor is yours, and I'd like to remind all our participants that they can ask questions through the platform on the box interactive discussion. Thank you very much. Joy, the floor is yours.
The final panel of our Infra Day. This is a panel which is spanning Europe and Americas, as we have a distinguished group of speakers who are joining us from 3 time zones. So we continue our focus on the pandemic and now turn to the perspective of investors in infrastructure debt. Our participants will provide their views from the Americas as well as EMEA. From a global standpoint, we see that the run rate for infra debt has been similar to 2019. But this masks differences by subsector, geography, and market. We will also try to consider some relative value aspects. For instance, the real estate market in the US, which is orders of magnitude bigger than the infrastructure debt market, and it is down 30 to 40%. What lessons are being drawn from these? We hope that our panelists will have some views on those. And then in the Americas, we've seen that while North America was down around 7% at the end of Q3, some very large investment grade refinancings were completed in the US. From Natixis, we were part of some of these transactions as well. So we can continue to see a lot of business during this period. Also, LATAM at the same time was down around 58% relative to 2019. Though we and some of you, in fact, on this panel, completed deals during this period. And at the same time, the other aspect to talk about is the public markets. So we saw that the public corporate bond markets were breaking records. One of our panelists here, Tony, who leads our DCM efforts, must have been extremely busy. At the same time, project bonds remained more muted. So the question is, what are the dynamics at play here? How did debt investors look at these markets, and what is the outlook? Very interested to hear the views of our panel on. With that, I hand over to my co-moderator, Antoine, and he can take it away on EMEA.
Thank you, Joy. Good afternoon and good morning to everyone. So yeah, I'm Antoine Saint-Olive, in charge of distribution for infra and energy finance in the EMEA region. Just a few words about what I've seen in the European market over the last 6 months. So Europe is probably the region which was the most impacted by the crisis when you look at the number of deals and the notional amount of debt that was closed, which have decreased by 35% and 21% respectively for the first 9 months of 2020 compared to the first 9 months of 2019, according to data from IG Global. So in terms of evolution by countries, the most impacted country is definitely the UK, where volumes were divided by 2 over the period, which put the UK behind France and almost at the same level as Spain. Italy was also severely impacted with only 1 billion of debt closed so far this year. France has proved relatively resilient, boosted by large deals closed in the offshore wind and in the telecom sector. And Spain has been stable over the period thanks to a strong activity in the solar PV sector. In terms of sectors, so renewables continue to be by far the most active sector in the European market. It's more than 60% of the total infra debt. Telecom is not only resilient, but I think it benefited from the crisis. This is now the second most active sector with 5 billion of debt closed in 2020, which is a 25% increase compared to last year. And we understand there is quite a lot more to come later this year or early next. And transportation, obviously, was the sector the most impacted, with 75% decrease in debt volumes during the first 3 quarters. Now, in terms of how the debt providers active in Europe have reacted to the crisis, I've noted a kind of mismatch between banks and non-bank investors. Basically, at the beginning of the lockdown, most banks were very cautious about new activity because they were constrained on liquidity. Their priority was to allocate liquidity to support their core clients, and they were quite busy with drawdowns on their RCF and the liquidity facilities. And as a result, the cost of funding of banks has increased relatively substantially between 50 and 100 basis points in average. And at this time, the non-bank investors were still active. I mean, they had plenty of liquidity available to deploy, but they had no relevant benchmark to price the transactions. Since then, it has changed quite a lot. And as we speak, the bank market has more or less normalized. It is where it was pre-COVID in terms of liquidity, in terms of debt structures, in terms of pricings. NBFIs still have a lot of liquidity to deploy. Maybe they are a little bit more conservative in terms of risks than before. And given the relatively low volumes of new projects in the market, that may force them to push pricings down in the investment grade territories, while on the opposite, they may need a relatively high premium for non-investment grade credits. With that, I look forward to obviously hearing your views, and I suggest we start with an introduction of our panelists. So maybe Alban, if you want to tell us about you.
Sure. So I'm Alban Lasselle. I'm the CIO of Generali Global Infrastructure. Generali Global Infrastructure is a platform that has been set up with the Generali Group. We invest in infrastructure and infrastructure debt to start with. And we have in fact two strategies in this market. We either invest around first strategy, which is defensive senior debt, or the second strategy, which is investing on high yield or enhanced return kind of assets. So we have today deployed around 2 billion euros assets, and we have 3 billion euros of assets under management. So that's where we are. We are mostly investing in Europe today. We have some assets that we are managing which are based in the US, and we look forward to investing more in North America in the coming months.
Thank you. Maybe Charles-Henri?
Good afternoon. So my name is Charles-Henri Lecointe. I'm co-leading the infrastructure debt team at Legal & General Investment Management with a responsibility for North America. So I've relocated from London to Chicago around 12 months ago. So it's been a very interesting time to be in the US, and it's been a lot of fun as you can imagine. So LGIM has been active on the private debt side, investing into infrastructure since 2013. And we have a team of 10 people. 2/3 of the people are based in London and 1/3 in Chicago. And our focus is really both on Europe as well as North America. And we've also been active looking at Australia. We have invested to date around £7 billion into infrastructure as well as utilities, with around $1.5 billion invested into North America. And our key focus is investment grade debt and fixed rate debt investor.
Thank you, Charles-Henri. Mansi, hello.
Hi, good morning, good afternoon. I'm Patel. I work with MetLife Investments Management on the North American portfolio for our infrastructure assets. We manage about 29 billion assets under management in the infrastructure portfolio across the world. About half of that is in the US, so about 14 billion of US investments. In 2019, we deployed about $7 billion across infrastructure investments. Our focus is also similar in the sense of senior secured investment grade portfolio, although we do look at some opportunities in the BB space as well. It's been an interesting year, as you mentioned, and the sectors have varied in terms of investments on our side, but we continue to have a fairly strong year to date and hopefully bring it to a strong finish in the fourth quarter.
Thank you, Mansi. Hello, Anthony.
Hello, everyone. Tony Ferraro from Natixis. As mentioned, I am responsible for our private placement and project bond practice, but also have responsibilities for our debt capital markets, corporate origination on the public investment side. And we'll be primarily speaking from that perspective in order to compare and contrast, complement our existing panelists of private debt infra investors.
Okay, well, let's get started. Antoine has talked a little bit about the impacts that he has seen on the EMEA side, on the various different sectors. What we would really be interested to hear about are your perspectives on certain subsectors. Let's start with what I think are probably the positives. and also span both Americas and Europe. Let's start with renewables first. Maybe should we start with Alban? Do you want to give your view on how you've been seeing the renewable sector for Europe and Americas?
Sure. No, the renewables. So what we see from a portfolio's perspective is very positive. The picture is very positive to the extent that you have the right contract, that you don't have any exposure to the market prices, that you have a feed-in tariff or PPA. So there is obviously no issue here with COVID, no problem at all. Actual obligations are being met, so that's everything is okay. And we see, in fact, a clear interest from investors to look at the sectors more specifically. And we've seen some indices in this market tracking the equity interest on this sector, raising by 32% from the beginning of last year till the end of July. So we see a clear interest coming from investors in this field. So and it's normal. The sector seems to be quite resilient. The issue that you may have is that if you have some exposure to the merchant price, then that's a different story. We've seen that prices have been going down quite substantially in certain markets in Europe, going down by 50%, for instance, in Spain. But since then, prices have started to recover a bit and are almost back to where they were, apart from in certain markets like the Nord Pool market. So if you have some exposure to the merchant price, to the merchant price of electricity, you could have some problem, even though the problem might not be too acute at this stage. What I believe is sort of more an issue, and what we should be focusing perhaps a little bit more going forward, is really the exposure to subsidy. As we all know, a lot of those projects that dates, which are old vintages, have been financed 10 years, 15 years ago, when technology was much more costly, when interest rates were much higher, and result in the price of power, which are very expensive, that's either the end user or the taxpayer ends up paying. And that creates some issue. That can be quite substantial issue. This is not a new risk. Normally, we tried to gain some comfort with the fact that energy transition is clearly something which is embraced by most governments. As a result, governments should behave and should not renege on the commitments that they have taken. But there is less a need for the government to ensure that the environment from an investment standpoint is clean. Those projects don't need any subsidy anymore, the new one that needs to be financed to meet the transition targets. So to a certain degree, the government are freer to sort of play on the tariffs that are that have been negotiated 10 years, 15 years ago. And that's where I believe we are seeing some issues. This is not a new risk. This is clearly not a new risk. We have seen this issue emerging and surfacing at the aftermath of the great financial crisis in 2013 in Spain, then immediately afterwards in Italy, where we've seen some tariffs being negotiated down. And now we see that the COVID crisis is obviously having an enormous impact on a lot of on the economic sector, on the energy sector as a whole, but also on the public finance of these countries. And as a result, we start seeing now the French government trying to renegotiate some of the commitments that were taken through feed-in tariff back in 2011. So this is something to look at. And in fact, the point is that with this COVID crisis, we've seen one aspect, the first aspect and the first effect of the crisis that we've seen up till now. But there's going to be a ripple effect, presumably, taking a little bit longer time to manifest itself in the future, and that may affect the renewable sector to a certain degree, especially for the old tariffs, the old generation of power generation assets, which are not benefiting from the substantial savings that have been made on the solar panel. The solar panel has been divided by 10 in 10 years. So There is this point, which I believe is something to be monitored on the going forward basis. We see already some risk coming from France. And it's important also quite funny to look at the way it's being done in the US as well. In the US, there is not so much of a subsidy paid on an ongoing basis. Everything is done through PTC or ITC, which are in fact monetization of tax savings that investors in renewable energy projects benefit from and inject in the project. There is no ongoing cost borne by the community to pay for those subsidies for those projects. So there is less of a risk in the US, I believe, than we have in Europe with those feed-in tariff with all older generation of assets.
That's a very interesting contrast between the two. Mansi, perhaps you can jump in. I also have a sort of a question related to construction risk. You know, I mean, in general, and this is not just renewables, but this is a general issue we've been hearing about. Force majeure being an issue during this period, and in some cases, people talking about delays and so on. Do you have a view, or maybe you can talk a little bit generally about the Americas and also what you've seen on the construction?
Yeah, sure thing, Joy. On the renewables point in the Americas, that sector continues to be a shining star. You know, even through March, starting in March to now, that's been the most active sector for our portfolio broadly. I think there's been a continued demand for infrastructure debt to support those assets, and renewable assets suit really well to ESG funds, sustainability goals for issuers like ourselves, investors like ourselves. So we continue to see a very strong demand for renewables and solar and wind across the country, and we continue to be very active in investing. On the construction side, we do think renewable projects are easier to construct than, of course, a natural CCGT or anything of that effect. But the importance really comes in on your contracts and to ensure that your EPC contractor under a fixed price contract overlays nicely with your PPA contract that takes you out. So what we've seen is there has been some delays due to labor or materials, but they've been very marginal, to be honest. I think we've kind of managed through the COVID impact well in the sense of managing construction risk for renewable assets. Although, you know, the biggest point is to make sure that if you do have a delay, you're not meeting the long stop date on your PPA, and then you're going to be a merchant project at the tail. So we have not seen that come through. So I think, you know, from a construction risk perspective, we feel quite good on the renewable sector. The one sector we are watching construction is on the public-private partnership side, where you have, you know, 3-4 year construction periods, which are quite long, and the ability to absorb a 6-month shock to that construction schedule. And so far, we've seen that our counterparties have been able to manage their schedules appropriately. I think, you know, people are back on sites and construction has been proceeding carefully. And so people are managing through it, but it does highlight the importance of understanding your contracts and understanding how the long stop date can affect your takeout and making sure you manage to it. So, you know, we are not shying away from construction risk. I think it's something that we're fine to take and comfortable with, but we do continue to monitor the counterparties, which is obviously most important to make sure your EPC contractor can also survive the liquidity impacts such as COVID, and also making sure your PPA counterparties and your revenue counterparties are high credit worth entities. So we continue to see good activity there, and I think the Americas market continues to be quite strong in the sector.
Yeah, and I would agree. I mean, on our side, we've seen, for instance, there was one case we had our inverters on a solar project were sitting on the docks in China, and for a while because there was, they just didn't have the ability to load them. It caused a little bit of a delay, but because of the float in the timetable, it was all came right in the end. So it wasn't really as much of an issue as one might have thought. So it's actually, quite a positive story there. Maybe what I'd like to do, and I'll move to the next one, which is the next positive one, I think, which is because of the probably the outlook is telecoms. And perhaps, Charles-Henri, you haven't had an opportunity to comment yet. Maybe start with you. Have you been looking at the telecom sector, and what have you been seeing recently?
Yeah, so I think, I mean, on the telecom side, I mean, we've seen more pipeline opportunities in Europe compared to the US. I think what has been the challenge is really, I mean, as I say, we are an investment grade debt investors, so it's really seeing this transaction which can really get to the right rating, because yeah, a lot of these transactions do have some ramp up risk and so on, which is not always an easy risk to take on for investors. But I mean, we are very hopeful about the sectors. We think that a lot of opportunities are going to to develop, and then when the right time will come, this will become investment grade debt opportunities for investors such as us. But I mean, it's very clear that with COVID-19, there's a big focus on digital infrastructure, and yeah, we're keen to participate. I mean, in the US, I mean, we've seen also some transactions where people are trying to use a private-public partnership type of framework. So in order to get comfortable with construction risk and operational risk. But as I said, I mean, from my side, I've seen less opportunities in the US compared to Europe. But yeah, definitely a very active sector. I think it's a question of maturity. And,
Mansi, Alban, do you have perspectives that you'd like to bring to this on telecoms?
Yeah, on the telecoms. Go on, sorry. Go on.
Apologies. From our perspective, I think we'll echo what Charles was mentioning. We haven't seen as much of a universe of opportunity sets in the US. We'd like to participate, but the deal flow has been spotty. And where we've seen procurements fall apart is actually in broadband. So Georgia was trying to initiate a broadband program in their state, and that was pulled eventually because the bidders weren't able to get there. And so we're trying to find the universe. We think it's obviously a sector that's going to grow and is necessitated by and amplified by the need. But I agree with Charles, there is just not a universe of a strong opportunity set at this stage, but hopefully that's more to come.
Do you have telecoms deals in your portfolio at the moment, and have they been performing kind of okay during this period?
Yeah, it's a smaller subset of our portfolio, but where we are active is in Europe and in Australia.
Right.
So we do have overseas, but none in the US. I think the US market continues to be the larger telecom that access through the public markets. So we haven't seen a lot of private debt activity in the space in the US, but our portfolio has done quite well in Australia and EMEA.
Okay.
Yeah, and then we have, sorry, go on, sorry.
Yeah, go on, Alban.
I was just mentioning on the behavior of those assets in the portfolio to your question. Obviously, we've seen the resilience of those assets, even though we have quite a decent exposure on the infrastructure telecom sector on our side. In Europe, there's been a sort of a healthy deal flow in the last months, and we've been participating to that. And what we've seen is that despite despite the lockdown in France, for instance, where it was not possible to carry on some works, some physical works for the construction and the layout of those fiber networks, there has been very, very strong figures in terms of subscribers. And in fact, in Q2 in France, the number of subscribers has reached a record level. So that's the Q2 for 2020. So that's something which is really comforting and really speaks the resilience and the need for this telecom infrastructure sector.
And maybe to complement on that, on the telecom sector, just one word is that the universe of lender in Europe is increasing substantially, meaning that 2 years ago, I think telecom was an exotic sector, like offshore wind when it started. Now it's almost a commodity. Meaning that many banks and many investors are getting more and more familiar with the sector, and there is definitely more and more liquidity available for this sector to a point that there may be some concerns, since there are many transactions ongoing in Europe, that the telecom pockets at some point may become full, while the pipeline of new transactions is still very abundant.
So maybe moving to something, things which are could be a little bit more controversial. Let's pick two areas together, which is transportation, which is more of a European topic, I think, and then oil and gas. So and we're really focusing here on kind of the performance during the crisis. Maybe who would like to jump in on that? Someone want to provide their views on those two sectors?
Yeah, I can.
Charles,
do
do you
that.
want to? Yeah, sure.
Yeah, so happy to speak about transportation. I think it's been very interesting. I mean, looking at our investments in North America and Europe and Australia. I mean, for me, it's not like you can't speak about the sector as a whole. You've got really, I mean, airports suffering a lot in terms of passengers. You've got roads which have done relatively well. I think it all depends on whether, you know, on how much the truck traffic is, and then you've got ports which I think have overall, you know, performing quite well, and there are really, you know, different reasons. So airports, it's pretty obvious. You know, borders are closed. You know, no one is really keen to fly right now, and a lot is being done, you know, via virtual conferences. And there is a question about the long term, you know, what's going to be the impact for business traffic. What I think is quite likely to happen is that, yeah, a lot of people are going to be keen to travel again. And yeah, so me being the first one keen to go back to Europe at some point. I think the airport is, you know, definitely the most impacted. I think in terms of roads, they've been quite resilient. Of course, in Europe, strict lockdowns have seen traffic decreasing a lot. In the US, it's been more of a partial lockdown. So we've seen, you know, traffic kind of holding relatively well, especially if there is a high component of trucks traffic, for the simple reason that people have continued, you know, to need goods and so on. And we'll see also in the long term what does that mean, because I mean, there were a study published yesterday saying that 25% of people would be opposed to taking public transport. So in the US, where car is really important, you could expect more and more people to continue using their private cars as opposed to public transportation or using Uber and so on. For ports, it's been, you know, kind of the same story about, you know, people have continued to consume goods and so on. I mean, we've all been stuck in our bedrooms, you know, so keen to try to improve our every daily life. And I think if you've been targeting the right assets, I mean, you've been doing well. I mean, we've got even a port asset which is you know, ahead of their pre-COVID budget. So it's all a question about, you know, how much is gateway volumes, how much is transshipment, which can be moved. So not every asset has performed in the same way. But I would really say, you know, airports, you know, performing the worst. I think roads in the middle, and then ports doing relatively well. I think the question is going to be, you know, what about the future, and how do you look at these assets going forward, especially in terms of sensitivity. I mean, usually what you are doing when looking at this asset was, okay, what has been your kind of worst case scenario? So the GFC for obviously. So now it's going to be a question, you know, how do you look at the risk of another COVID happening in the next few years? Is there enough liquidity being built in all these projects? Which is an important point. I mean, on our side, I mean, for some of our investment, I mean, we've been very constructive, speaking with sponsors, you know, discussing some additional liquidity for the project, especially if we think that the assets have, you know, are very strong in itself. So it's more of a short-term stress and hoping for things to improve relatively quickly in the future. But it's definitely an interesting sector for debt investors, and and time will tell what's going to be the impact also from an equity perspective in terms of you know, EV to EBITDA multiples. I mean, are people going to be happy to pay the same type of multiples when there is definitely a risk of another COVID potentially happening in the future? So it's so definitely a subject which has required a lot of focus. As I said, on our side, we've been fortunate and we've been very diligent in the type of investment that we've made. So it's so we are in a good shape given the stress that we've seen in the market.
So it looks like
I like your ordering of the airports, roads, and then ports. I think on the roads, I would add a nuance that I was reading about, which is if you look at passenger traffic versus you know, truck traffic. Truck traffic, of course, has been far more stable, but where you have kind of road, you know, passenger traffic, it's been much more volatile. As you said, it went down a lot, like went down 90% in some cases. In the Massachusetts doc looked at that. But then now when people are coming back to work, if they're not using public transport, it may actually go beyond regular flows. So it's a much more volatile area. I don't know whether, Mansi, whether do you have a view that,
Yeah, absolutely. Just to add to the transportation, and what we've seen is really the importance of your sponsors, and a financial equity sponsor or equity sponsor made quite a difference in how they approached the liquidity crunch that they were anticipating, right? You had passengers going from full capacity and falling 90, 80, 90% across kind of there and parts of the world. So we spent a lot of our time negotiating and discussing covenant breaches because with private debt, you have meaningful covenants that the projects are breaching with that level of EBITDA decline. And so what we found actually is a lot of our portfolio had access to the public markets and to infusion of equity. And so these assets are struggling in this COVID environment, and revenue is down, but their balance sheets are quite strong in the sense that they've raised equity where they could. They've issued subordinated debt to build up liquidity. They've infused cash, and they're managing through the crisis, I think, in a very appropriate way. So we recognize that this is sort of an uncontrollable scenario, but we think the portfolio has, the owners have proactively protected the assets. And that's really key, right? Because nobody could have predicted a 7-month shutdown of literally no traffic movement of people, and to survive that and work through these covenants in a very sort of partnership manner, right? We're protecting liquidity, we're protecting ratings, right? For as debt investors, ratings matter, and a rating downgrade matters to us from a capital charge. So we're trying to build bells and whistles into the structure to protect us, but we're also working with the equity to get through it. So we think, having the right sponsors, having equity at risk, all those things start to matter. It's sort of PF 101, but it matters quite a bit right now, and that's resonating really strongly in the transportation sector.
I know Antoine is burning to ask some more questions, but before we just go into that last piece, which is oil and gas, which is a very interesting kind of dynamic, we've seen that on the downstream side on LNG, there has been, there have been some refinancings during this period, some $1 billion plus refinancings. And yet in the upstream side, of course, there has been carnage. So interesting to hear your views on, on oil and gas and what you've seen during this period. Who would like to give us a quick view? Sorry, go on, man.
Yeah.
Yeah, so for Met, our energy sector in the infra portfolio is LNG and it's pipelines. And so it's largely contracted infrastructure assets. We're not exposing ourselves to commodity price risks or declines in commodities in oil and gas. So that naturally protects against sort of the volatility in the environment. And then you go to counterparty risk, right? LNG assets, the portfolio typically has counterparties across the world. And the ones we were watching most closely were our Asian counterparties, because we were concerned of force majeure clauses that could be raised and sort of disrupt the payment flow. Those conversations were being had, and they're headlines that make you kind of anxious as a project finance investor, right? You don't want your counterparties talking about potentially non-payment events under your revenue streams. But ultimately, there was a period of time where that was discussed and that went away. And it just comes down to the strength of your contracts and the strength of your counterparties, because the LNG assets these are long-term investments, go through cycles. This came quite immediately, but you go through economic cycles and they're built to sustain this type of volatility. So we've seen our portfolio hold up quite well. There's a few counterparty relationships that, that are struggling because, for example, on pipelines, you'll have your upstream as your sort of revenue counterparty. And so we're watching those, but we haven't seen meaningful stress. I think the most notable one is Oxy, who had some meaningful downgrades, but that was driven from an Anadarko acquisition. And so that was sort of preceded COVID as well, the rating stress on that counterparty. But away from that, there's really no meaningful examples of stress in our portfolio in the energy sector. So it's actually held up quite well.
Right. Alban, were you going to say something now?
No. I was just going to say that we don't have any bad signs in our portfolio in oil and gas because we have not invested in oil and gas. There is a possibility on that.
Okay, so maybe we move on. Antoine, over to you.
Okay, no, so it looks like the portfolios have been resilient so far. That the acid test is passed. Now we need to think about the future. And then I was wondering if you could tell us a little bit about your fundraising activity. How are the end investors behaving? What is their, basically their conclusion from this COVID experience? Are they still willing to invest more money in this sector? And how do you see the prospect of fundraising going forward? How has it been over the last 6 months? I guess it's been maybe a little bit quiet. And how is it going these days? Alban, maybe you want to comment on that?
Sure. No, I think this crisis, which is not necessarily fully over, there has been, I think the asset class has proved its resilience to a number of investors that either did not know or were not fully convinced about the resilience of the asset class. So I think that's clearly something which is established now at a wider universe of investors. We have seen, in fact, some investors recommitting after the crisis in our funds. So that's something that we really liked and something that we were quite pleased with. We've seen some investors committing and we onboarded them during the COVID crisis in the months of April and May. So that was something which was very good. So there is, for a number of investors, they really see the resilience of the asset class. And this interest that we see has been clearly evidenced by one study that we've seen, which was polling a large pool of LP and the study established very clearly that most of the investors that were polled were looking forward to increase their allocation on infrastructure. So that's something which is very positive. We're very pleased with this outcome. I can't say, I don't know whether what we see is something which is applicable across the universe of investors. There may be some investors that may have their fingers burnt on a number of funds that are heavily invested in sector, differing and different way to look at infrastructure asset class. But all in all, I would say that there is a regain of interest on the asset class that is clearly that we clearly see and that we are sort of benefiting from through our fundraising exercise, which is carrying on quite well.
Thank you. Charles-Henri, you've spent quite some time in Europe. You're now in the US. Do you see any difference between how the investors behave or react from one continent to another?
Yeah, I don't really think that there are, that much of a difference between the two. I think, as Alban said, infrastructure has shown the resiliency and so on during COVID-19. There is nothing better than a crisis, I think, for infrastructure to show, all the long-term advantages of investing into the asset class. And I would expect something similar than what we've seen after GFC. When suddenly the interest for infrastructure increased a lot. Of course, when everything is going well, there is less appetite for, very strong and stable cash flows. And of course, when COVID-19 is happening, there is suddenly the asset class can show all the positive attributes. I would say, for me, the big difference between European and US investors is probably, the focus on ESG. What I would say is that compared to a year ago, I've seen definitely things are moving very quickly in the US, and there is definitely a catch-up in terms of, looking at what is the impact on environment and so on. And we've seen a lot of quite dramatic weather events in the US. So between the wildfires and and all the other, hurricanes and so on. So it's definitely coming, more and more on top of the agenda. So in terms of fundraising, yeah, I would say, investors, continue to have a lot of appetite. There is probably even more appetite than there used to be. And and time will tell. I mean, the industry, is all maturing. Of course, infrastructure debt is behind infrastructure equity. But it's very useful to see a crisis such as this one to show, what is good about investing into infrastructure debt.
Thank you. Maybe a few words about the bond market. Tony, what are the recent trends in terms of volumes, returns? How do you see the public bond market? How did it behave compared to the private debt market?
Sure. Yeah, no, it's a good segue. I think the public market, in summary, has reached unprecedented levels of volume this year. Just the investment grade U.S. dollar market is around 1.6 trillion currently year to date. The former record in 2017 was 1.35 trillion. That was reached in August. Things really changed in March. March 15th, the Fed came out and cut rates to zero, also announced quantitative easing program, sizable quantitative easing program, in part to buy investment grade bonds and investment grade bond ETFs. That really provided a backstop to unleash liquidity in the marketplace, and really the cash flowed from there. I mean, from the issuer side, naturally infrastructure debt is in many ways different than what I'm talking about here, which is mostly corporate and financial institutional issuance, where a project, will generally go through a construction phase and then an operating phase. And in many ways, the construction debt is short term, and then the long-term debt, once in operation, will be so-called permanent capital. Sponsors and issuers were clearly sitting on the sidelines at that time while the volatility was in its most heightened state in March and April.
Thank you very much. Sorry
really
about interrupting. Sorry to interrupt, but we need actually to wrap up and move on to the questions. I'll let you finish the sentence and we move on actually to the questions.
Sure. I guess a quick summary is that the public market, liquidity has been flowing. I think we saw a lag period for infrastructure debt, which has come back online in earnest, and there's now pent-up supply coming online really since June. But in summary, liquidity is flowing, and we've sort of retraced back to near pre-COVID levels with all-in rates even lower than where they were before.
Thank you very much. Thank you to all of you from 3 time zones. Actually, it's very exciting to have all of you together. We have a couple of questions, so let me ask you, how do you explain pricing has not moved up and structures have not improved whilst we are actually going through the most severe crisis since the global financing crisis? Any ideas?
Presumably because there's a lot of liquidity. I think hello?
Yes, Alban.
Yes, I think there is a lot of liquidity, which is basically spurred by the central banks, which are sort of injecting a lot of liquidity, which basically sort of pump up the demand for investment. And then, so there is a disconnect. It's true, there is a disconnect between the economy and the financial world. That's something to monitor, actually.
So maybe just a quick follow-up on this one. So it looks like the pricings are low again, even if we are just after the crisis. Is it time to invest in something a little bit more complex, a little bit more structured, a little bit more holdco, mezzanine? Is it time to invest in toll roads or in airports? Or is it too early, and would you prefer to stay in a good investment grade territory?
For us, I think some of those, yes, not all of them. I don't think we're at a stage where we can go into very long-term transportation or volume-based assets without visibility on the modeling, right? The modeling is very critical for long-term investments. But where we have seen some opportunities is in a space of liquidity lines. Some of the assets that are struggling or perhaps need benefit and support from liquidity, we've been able to find some very nice investment grade assets, but in the sense of providing shorter term liquidity support where you can pick up some value propositions as well and you're comfortable with the rating. So I think it really depends, and being very critical of asset selection is quite essential. So we'll continue to focus on the longer term model perspective, and there it gets a bit more challenging, but you can certainly structure. And to the prior question on structure, I do think we've seen some better structures put in place over the last 6 months to address some of the challenges. I think going forward, you're going to start to see, COVID reserves for pandemic reserves and assets that need them to build liquidity. So I think the market will react, and I don't think that we've kind of just been in a steady state for the last 7 months. There has been an evolution to enhance structure to address some of these risks in the private sector. I do agree liquidity is quite strong and sponsors have choices. But from a private debt perspective, we've been able to enhance some structures where we could.
I mean, the only additional point,
I agree with Mansi in terms of structures. I mean, we've seen, stronger structures coming to the market or investors pushing back and seeing, different variations where, because people are definitely focused on, on the downside. What's really important is the capital charges. And of course, for an investment grade debt investor, what you really don't want to see is the asset migrating to non-investment grade, because suddenly your capital charges are increasing a lot. So it's so it's making sure that the asset is more resilient on the downside. So I mean, on my side, I would say that I've seen structures getting stronger, which I think is a good thing for the market. I think pricing is kind of an interesting one. Spreads widen a lot, but there's been quite a lot of tightening in the recent months. I mean, all in, if you look at where treasuries are, the cost of debt, I mean, still looks attractive. But I would say that it's in terms of appetite for BBB- ratings, I mean, you would need to see the asset to be very strong on the downside, because as I said, you don't want to see the rating being downgraded very quickly after you enter into this transaction. I think it's a different thing to, no one was really expecting COVID-19. I think now when you're investing, I mean, your investment committee, your clients are expecting you to have a look at all these downside scenarios and to invest in the right type of assets in this environment.
Thank you very much. That will be actually the conclusion. Charles-Henri, Mansi, we have all the panelists that we just had. Thank you very much for this interesting, all of you, all the 4, 5, 6 of you. Thank you very much. We'll now close this session, and we are going to meet for the closing speech at about 10 minutes. In about 10 minutes, we have the pleasure to have Anne-Christine Champion, the Global Head of Real Assets at Natixis. See you in about 10 minutes. Thank you. Thank you.